It's very, very easy now for Bitcoin to be argued as a credible investment now that you've got these ETFs, you've got BlackRock recommending allocations as high as above 70% in some analyst reports. Fidelity, I think, is 3% allocation. You just run that, say 3% of $550 trillion goes into Bitcoin, multiplied by anything from 1 to 5x, depending on where we are in the cycle. You get to some very large numbers very quickly.
Bitcoin's price could soar to new highs this cycle, according to veteran on-chain analyst Willy. With Bitcoin ETFs gaining traction, institutions like BlackRock recommend allocating over 70% to Bitcoin, while Fidelity suggests 3%. If just 3% of the $550 trillion global market flows into Bitcoin, the potential impact could be extraordinary, with a multiplier effect of 1 to 5x. Stick around as Willy explains why Bitcoin is a top investment this cycle.
Where does Bitcoin sit in a 10,000-year view? In this case, it was like 10,000 years into the past, not the future. But we can get to that. And really, it was like, if you were to look at the fundamentals of money, we started off with commodity money. And we basically built this kind of Lindy effect on gold and silver as money, because these things were very hard to get more of, very hard to inflate the supply. And as we moved into the industrial age, there was a change where we tended to trade the paper that was claimable for the gold and silver, because it's a pain in the ass shifting lumps of silver and gold around. So with the development of the industrial age, we started to paperize. Paper's much quicker, and then now we're in a digital age, and what we're seeing is a lot of online banking, a lot of digital payments, but that stuff's not internet native. And really fundamentally, Bitcoin solved this thing that was thought to be solvable, but it took until the Satoshi white paper in the tail end of 2008 to solve. What he solved was the ability to put scarcity online, because up till then, I send you a JPEG, you can just copy it to infinity. And so by putting scarcity online, it was the first time we could actually have a real internet native money. And so really the thought is we're in this kind of transition to a fully digital age where so much of our economy is online, and we didn't up to now have a digitally native form of scarcity, a form of money. And that's Bitcoin. And so that's the 10,000 years from the past to where we are now.
Do you think that we get rid of fiat completely with the advent of Bitcoin?
Yeah, this is a really interesting thing when you look at 10,000 years of money, and you find that, we've had first inklings of gold coins and stuff for I think 700 BC. And now we talk about money going from, world reserve currencies changing every 100 years. But you'll find that they were always tagged to gold or silver until this very, very brief experiment of fiat since 1971, when the gold window was closed. And that's never gone well in the history of the world. So I don't really look at this era of 50 years almost, roughly, as a real zone. You see Germany went off the gold standard, and it hyperinflated almost immediately. The whole world's on this fiat right now. I think it's a brief experiment. So now the bigger picture is Bitcoin's in the process or attempting to flip gold and silver, like multi-thousand years of Lindy effect, building trust in gold, silver as a form of money. And it's only 15 years into this. We have 15 years of data on it now, and it is going to be quick, and it's not even up for debate. People may want to debate it, but they haven't looked at the data. As of where we are now, it's very reliably 500 million people that have some sort of ownership of Bitcoin in 15 years. And if you run this data forward, we will be 1 billion people having some ownership of Bitcoin by the end of this decade. And by 2035, if this curve continues its path, we're pretty much near majority adoption of Bitcoin as an investment holding. And then the question is this going to be a reserve currency? Will it be money? Will it be a medium of exchange? But it's happening very, very quickly.
So we're at 500 million now, and you see us going to 1 billion in the next...
by the end of this decade.
By the end of this decade, okay.
Yeah,
so that's 2030.
Yeah.
Okay, interesting.
Because when I was starting the early research, I would do things like look at Google Trends and so forth, and things were doubling every year. That was how quickly it was growing. Now it's not compounding quite like that in terms of user adoption, but in terms of we're at 5% of the world, that'll compound very, very quickly because there's an adoption curve, right? Once you hit 16%, that's when you hit mainstream. It gets to 50% very, very quickly.
Yeah, when you map that against decreasing supply and another doubling in the adoption, this gets pretty interesting.
Yeah, and you think about it being barely over $1 trillion and the speed of the adoption and the fact that more than 99% of global wealth is not invested yet, and the kind of reflexive nature of this investment that like $1 invested can shift market cap $5 in a bull market. Bitcoin's set to explode into a very high number in the coming years, given this adoption. Very reliable adoption.
Yeah, interesting. And the ETFs have obviously pushed this all forward as well.
Yeah, and so it's very, very easy now for Bitcoin to be argued as a credible investment now that you've got these ETFs, you've got BlackRock recommending allocations as high as above 70% in some analyst reports. Fidelity, I think, is 3% allocation. You just run that, say 3% of $550 trillion goes into Bitcoin, multiplied by anything from 1 to 5x, depending on where we are in the cycle. You get to some very large numbers very quickly.
Fidelity's Bitcoin ETF saw $275 million in inflows last week, bringing its total to $12.11 billion, while ARK in 21 shares added $202 million, reaching $2.69 billion. Overall, Bitcoin ETFs have gained significant momentum, with total assets hitting $1.46 billion. This surge in demand could push Bitcoin prices higher in the months ahead. Now let's hear more from Willy Woo.
Also, you might talk about proof of stake in these digital assets. That's actually a form of political, social consensus that the people who hold the money are in control of that network, and they're going to do the best to say this has value. And so it's a different type of form of political money like we have in fiat. I mean synthetic exposure to Bitcoin's price, right? And so, I'm saying this is, in broad terms, it's really debasement of Bitcoin. It's a very preposterous statement. Everyone knows there's only 21 million Bitcoins that'll ever be made. But I'm saying that with synthetic exposure, we may have exposure of 42 million Bitcoins available. Quite simply, before futures and options came onto the market, if you wanted to buy a Bitcoin, someone with Bitcoin had to sell it to you. And people didn't want to sell their Bitcoin. And this is very much the case in 2017. Bitcoin rallied from $150 in 2016 to $20,000. And you notice the price went exponential because as people wanted to buy this, price had to rally because the people selling it was so few. So few people had it. Fast forward another 4 years, and the CME now has liquidity. All the exchanges, for the most part, were starting to offer futures, perpetual swaps, derivative instruments. Now suddenly, someone on Wall Street with, this thing's a bubble. I want to short this. That you just front your US dollars and say, I'll sell you that exposure. And so effectively, anyone going long didn't have to buy the Bitcoin. They could buy the paper instrument. And now anyone with US dollars could also sell you that Bitcoin exposure. So indirectly, there's only 21 million spot Bitcoin, but the exposure for people who are only interested in the movement of price, they could access the synthetics, and there could be, 100 million synthetic contracts of one Bitcoin equivalent to be bought. When we talk about the spot market and a real Bitcoin, that's secured by energy, and that is a very fair ledger and very hard to corrupt. Once you create a paper market around trading synthetic exposure to it, it creates kind of a dampening effect of how high the price can go. Because if there's a lot of people needing access to Bitcoin exposure, then a lot of people with fiat and you can print infinite fiat can fulfill that. So I always say, if you want to go long Bitcoin, you should not buy the paper, you should buy the real thing, because you're going to further the case of the price going up. And, to be clear, I'm highlighting a risk. This risk is not really that large right now, because we're somewhere around 2 to 4% of the total market cap of Bitcoin in paper, whereas gold is 100%.
Yeah.
So it's still very low. I think that Bitcoin, if it grows quick enough, Bitcoin is barely over $1 trillion. The US M2 is 25 trillion, something like that, in the mid-20s.
Yeah.
So if Bitcoin starts to approach USD market cap, and it can do that quickly, over the coming decade, and then it becomes quite immune from that type of paper attack. It's a different risk with the ETF, because the ETF is spot. I'm tracking it on chain as well, because when you buy more ETF, more spot Bitcoin flows into custody.
Yeah. So
in that regard, it's helping this balance where institutions can now buy spot through the ETF. That's a different kind of risk in that we've all said, not your keys, not your coin. And if we get enough centralized entities that are holding the Bitcoin, then it opens up the risk of nation states basically taking control of that. And that's exactly how we ended up in fiat. Gold standard was great, except it was many nations that hold the gold reserve, and then Bretton Woods meant that it would be the US that would hold the gold in Fort Knox, and everyone would trade to the US dollar, and the US dollar could get the gold if you claimed it. And at some point in 1971, Nixon closed the gold window, and they snipped that claimability. Number one, the gold was never audited. Right? We never knew if it was all the money in the world in this one spot, and it was never audited. Bitcoin, every second we know the audit of that and who holds it. And number two, currently it's so decentralized, the government cannot seize it and then snip. In a new Bitcoin standard, if you're denominating in Bitcoin, they cannot snip it if it's decentralized. So that's the risk, I think. It's a risk, but it's the corporate treasuries, it's the spot ETFs, it's the custodians for the high net worth. Like, those are easy points for a government to create a story in which you got the Bitcoins, but we're going to take stronger custody of it, let's say. They might say something like that. We're broken out of a long-standing sort of, in trading terms, a consolidation triangle. And so, like, currently there's a lot of liquidity coming into the system, meaning governments are printing more money. And with the high interest rate environment actually money was being pulled out of the system, and you could see that we had a lot of pullback in all the risk assets, and equities pulled back, Bitcoin pulled back. And every single cycle in which liquidity was injected into the system, more fiat being printed, Bitcoin has rallied. Not immediately. It takes, I think we've talked about, more than a couple of months before it really rips and takes hold. And so we're in an era where probably we're gonna rally hard, maybe tail end of this year into next year. Typically, these are 4-year cycles as well. People think it's a halving pushing the price of Bitcoin up because there's a supply shock, there's a reduction of new supply coming in, but also reinforcing that has been the 4-year liquidity cycle. And so we're in that phase now.
ETFs provide direct access to Bitcoin, driving more spot Bitcoin into custody and opening the door for large-scale investment. This boosts Bitcoin's accessibility in traditional markets, but also raises centralization concerns, as ETF-held reserves could face regulatory risks. For daily crypto insights and expert guidance,